recording, and then let me maybe share screen on Discord here. So screens, and then this away. All right, so one of the first things I wanted to go over here, I just want to double check. I know you guys mentioned you can hear me, so hopefully I'm good. But one of the first things I planned on going over was, let me see if I can pull it up here. I had some notes on it, was A book and B book brokerages, and then also kind of relating that to common prop firms that we know as well. And the reason being is I'm seeing a lot of people in chat talk about their prop firm evaluations and how, you know, they're losing trades, they're getting a bunch of slippage, they're losing out to spread or missing trades, etc. And I just want to bring awareness to the situation. And I want to also explain something in the past that's happened that, you know, the newer traders coming into the prop firm industry and using them don't really understand. And that is, number one, the difference between A book and B book brokerages. So when you trade with just about any brokerage, it is very likely, unless you are an institution or a hedge fund trading a lot of capital with a consistent record, you are most likely trading on a B book brokerage. And there's also an A book, which means that you are directly getting your orders placed into the market, foreign exchange in this case. And then there's B book, where your orders are not sent directly to the real market, but they essentially hedge against you. Your brokers hedge against you. And actually, I was curious before this. I did look at my forex.com account. I actually am on A book, which is kind of cool to see. I didn't know I could even look at that. But for the majority of traders, you are going to be on B book, and it's because the majority of traders obviously lose money in the markets. Now, this doesn't necessarily apply to people here as much as it does the gamblers and the 90% of traders out there who are uninformed. They don't have a strategy, they gamble, they open random position sizing and things of that nature. But an A book brokerage is what most hedge funds or institutions use, and that is going to be a direct placement of liquidity into the market. And as we talk about, liquidity is the sense that if I wanted to place a buy order on USD Chef right now at this price of, let's call it 8660, if I wanted to sell $1 million worth of this currency at this price, there needs to be someone on the other side of the market that's going to buy that $1 million order. It doesn't have to be 1-to-1, but it can be 100 people who all accumulate at the same price to buy that $1 million sell order. And it's just that simple exchange of orders in the market is what's known as liquidity. Many of you guys already know that if you've watched through the course content and whatnot. But that is how an A book brokerage works. You're essentially directly placing into the foreign exchange market through a liquidity provider, and you're actually getting your orders filled on time in live price. Now, the majority of us are trading on B book brokerages, and that's actually a brokerage where if I go to sell USD Chef at this price, my broker is going to actually buy and hedge against me, and because they understand that the majority of traders actually lose. Now, this is very, very common and actually speaks for the majority of brokerages. So yes, you are literally fighting against your brokerage when you trade. And I think it's important to, number one, understand that, because the deficit that you're at with B-book brokerages, yes, it is present. However, for the people who do find a consistent strategy, you know, they test it, they practice it like many of you guys are doing, you eventually can find consistency. And a lot of brokerages will actually move you onto A book if they're losing more money than making with you. So if you do have a consistent profitable equity curve over time, you got to understand that your brokerage is losing this amount of capital. So eventually they might say, okay, this trader's consistent, we're going to throw him on A book. Now, that's just kind of how your orders execute in the market. Obviously, if any questions, I'm going to keep popping back and forth here just to make sure. So ask any questions that you want. Because it is a little bit of a confusing topic, and some traders don't quite even understand that this is occurring. And then I wanted to relate this to the simulated prop firms that we operate with, or at least most of you guys. Now, the simulated prop firms is your firms like FTMO. I don't even know too many of them nowadays. Alpha, Apex. I think these are all some of these newer simulated style of firms. So one of the things to keep in mind is when you are operating on a B book brokerage, or well, let's start with A book. A book brokerages, their risk is essentially they are not directly exposed, so they pass the orders through the market, so they have no risk taken on. B-book brokers, when they hedge against your orders, they are taking on the risk that you are consistently profitable over time and you will actually lose that money. And then there's these simulated prop firms with essentially zero risk on their end, because all they do is they lend you these fake simulated accounts and then you trade on them. And if you do make consistent profit, in the markets, they will pay you out using the capital that they earn from evaluation fees. So do not get this mixed up. These prop firms like FTMO, Alpha, Apex, I don't even know too many. Fivers is another one I've heard thrown around. I think there's like a funded trader. You know, there's too many for me to keep up with nowadays, and that's partially because of the fact that they have virtually no risk. You know, Nova is another one, I think. And the idea is they make the majority of their money from these failed evaluations from traders. And this creates what's known as a conflict of interest as well, which is why people like myself in the US, and yes, this is correct. I'll touch back on that. But myself in the US, there's a lot of regulation with these firms. So I actually can't even trade with prop firms. There may be very few out there that allow me to, but it's because of this conflicts of interest they've created where they're essentially banking on their clients failing. And yes, B-book brokers do this, but they are regulated in a sense as well here in the United States, so that's why they can essentially get away with it. But when it comes to these prop firms, you are not on a live account when you pass that evaluation. So the evaluation is a simulated account. The phase 2 is a simulated account. And then even when you pass and you get this nice fancy funded certificate, you're still not trading live capital. And that's the first thing I really, really want to get across and make very clear here is that you are not trading live capital, a book in the market, utilizing that account. And in fact, you're not even technically B book because it is a simulated account. It is not a real trading account. And the reason I want to bring this to your attention is because number one, the risk involved, and that is that these firms are essentially working completely against you. So as a trader, if your main goal is to get funded with a prop firm, you cannot let it discourage you. If you're getting crazy trades from slippage, losing trades, too many break evens because of spread, all these ridiculous minute details within the firm standards and the simulated environment that they create is essentially to work in their favor. And that's where these business models get very, very sketchy, is if this firm solely makes money on the failure of traders, then you know, you got to really start looking into that business model and understanding, okay, if I'm going to take this from a professional standpoint, you know, you got to realize and not let the mental aspect of losing challenges, blowing them, spread, slippage, etc. affect you mentally or psychologically as a trader. Because what I see a lot of times, and especially with some people in the server, is they only go for prop firms. They don't trade their own capital. They're trying to hit big and get that 400K account, 200K account. And when they're losing challenges here and there, they're getting completely discouraged as if they can't trade. When what they don't understand is that that firm that they're trading for is legitimately working completely against them in the sense that it is banking on the fact that they lose. It's banking on the fact of, you know, increasing slippage, generating spread, and all of these things to kind of work against you. And the harsh reality is we never really know how fair of a playing field we're working within because everything on the back end of these firms is managed by themselves. So I'm not here to be the guy who just sits and shits on firms here. I'll talk about this real quick too. So yes, when your broker is trading against you, they close the trade as your trade hits stop loss. It's the same as if you hit a take profit. That's where your trade or your broker stop loss is, and they actually lose that capital on the exchange. So yes, they're hedging directly against your orders. That is how B-book operates because they understand that this is more profitable because more traders lose than win. And this is typically done on the majority of accounts. Sometimes you can see a different scenario with stuff like commission and spread being involved to make these brokers money. But yes, the majority of the case is along these lines where your broker is actually actively trading against you. But when it comes to these prop firms, I wonder if, so how is their risk So how their risk to reward match in this case, it's essentially the same. So they hedge directly against your orders. I'm not 100% sure if every broker is a direct match to your risk to reward and how it's set up. But yes, when you are buying in the foreign exchange, they are selling at that exact same price. And I'd assume from a simplicity standpoint, they're cutting their losses the same time you're taking your wins, and vice versa. They're going to take their profits the same time that you hit stop loss. And then I do want to scroll back up to dive into this a little bit here. So the reason I bring up, let me hide my bookmarks tab here so you guys can see if I can scroll in. Oh, it's going to be terrible quality. So let me just try to read it out for you. But for those of you that don't know and have not been trading with prop firms for too long, there was a prop firm known as MyForexFunds, which was the largest firm there actually was. They surpassed FTMO at record speed, and they were the largest prop firm in the world at one point. And keep in mind, this is a simulated prop firm, not a real one. Similar to FTMO, they are simulated capital, simulated market environments. They are not real prop firms. But MyForexFunds eventually got a subpoena and a lawsuit filed against them for tampering with accounts. And I will show you here, slip them to hell is the term that was used from a customer service rep there. Traders Global is their brokerage and their liquidity provider. So essentially what this part of the lawsuit is explaining is that the employee at MyForexFunds noticed that a trader was making a ton of profit on his prop firm account. And obviously they have to pay him out at the end of the month if he's making tons of profit over and over and consistently. And there is different accounts that these employees had at MyForexFunds where if I myself was doing really good as a profitable trader, they might say, okay, let's put him onto account aggressive now and switch the spread and slippage formula that we use to make it more likely that this trader is now going to lose due to things like spread and slippage. Because keep in mind, as I mentioned, it's a completely simulated market environment, meaning that they can control everything they want from spread to commissions to slippage to even the price on the charts that you are viewing. And obviously, when a company like a prop firm banks on you losing, this is where the conflict of interest occurs. And this is just one terrible, unfortunate scenario that had to occur in the industry regarding it. And that was them manually tampering with these accounts. So the trader was very consistent. He was making a lot of money. And they even put him on what's called the most aggressive risk profile. They had, I believe, 3 is what came out in the lawsuit. So number 1 was you were a brand new funded trader and you haven't really gotten any payouts yet. So you can just trade normally. Your slippage and spread is going to be pretty tame. Number 2 was, okay, they made a payout, maybe 2, and MyForexFunds did not want to have to pay this trader out again, so they would up their risk aggression in the formula that now calculates their spread and slippage and all of these factors that can affect your trade performance and your edge long term. They would amplify those so that now you are less likely to actually make money and get another payout with them, so they would not have to pay you. Dirty work, terrible business. But I really think this is important, especially for some of these new traders coming into the prop firm space. Super important. You got to understand that you're working at a deficit here. And I'm not saying that all prop firms are doing something like this, but you do never know behind the scenes what is going on. This came out through a lawsuit. I forget where, but I think essentially a whistleblower within the company. And a whistleblower is someone who just essentially leaked what was going on. So, you know, you never really know. And look, I'd love to say that not all firms are doing this, but it's one of those things that if one and the biggest that there was doing it, you never know about these subsequent ones. And when you really get down to the nitty gritty of it, firms like FTMO and MyForexFunds were very established and large firms. And nowadays, you know, I can't even count the amount of firms I can think of on 2 hands because there's new ones popping up left, right, and center. And all of these brand new ones, Alpha, Apex, you know, Nova, Cortana, whatever firms you can name at this point, because there's so many of them. If you think that all of these firms are popping up because there is an ability to do something like this, I think you would be right personally. And it's because if you are a brand new prop firm and you don't have the money to pay traders out on a 200K account when they made 2% profit, you're going to either, number 1, go to the rule book and you're going to deny them that payout. Or number two, you're going to turn on some type of risk aggression or amplify the formulas that make it harder for that trader to trade for you. And this is why the conflict of interest between prop firms and these simulated prop firms and traders like ourselves is increasingly growing. The conflict of interest is they only make money when we fail and lose money. So you got to keep that in mind. I see so many people DMing me and so many students telling me, they had a great trade, ridiculous slippage. It took them out of the trade and they lost 2% instead of making 4%. It's, unfortunately, the terrible reality of using these low quality prop firms. And I'm not saying all of them do this. Maybe ones like FTMO, those are the ones that we try to recommend because they are the longest established firms in the industry. But all of these other firms that you guys may look at and say, oh, they had a cheap evaluation, so that's why I'm using them. Keep this in mind and keep what I'm talking about here at the front of your mind when you're taking these evaluations, because you cannot, as a trader, let it psychologically affect you when you just lost 2% from slippage when you should have made 4%. Because the reality of it is you went with the cheapest prop firm. There is a conflict of interest. They only make money when you lose money. And all of these factors working against you is not even necessarily the realities of trading compared to trading on a B-book brokerage or a regulated brokerage like I trade with Forex.com, as you guys know. It's one of those things that I think is the advantage to personal capital is you're no longer at this deficit of conflict of interest. For example, Forex.com, I've been trading with them for maybe a little under 2 years now, and I originally switched from Owanda as well. But with Forex.com, I noticed that I am on a book now, which simply what happened is they probably realized with a consistent, performance over the last year and a half that I've been trading with them, I am now eligible for a book. So they simply switched me over, and now they make money when I make money, and everybody's happy. Compared to a B book trader who they are hedging against his trades and actually losing money if he's doing consistently well. That conflict of interest is completely flip-flopped, and now they can make money and we're both happy, compared to these prop firms where it doesn't work that way. There is no world where I can make money for this prop firm and they are going to be happy. That goes for FTMO, MyForexFunds, and any other prop firm that pops up, because at the end of the day, they are paying you out with the failed evaluation capital from other challenges. It's a little scary. Is the webinar recorded? Yes, it will be. Yeah, sorry about that, but it will be recorded and it'll be sent in that live sessions channel, usually within 30 minutes of it ending or so, depending on how long the render takes. But it is a bit scary. I will admit, I don't want to be the big pessimist of prop firms, because now I want to talk about the good side of prop firms, which is going to be the leverage you have on your capital, because there is no other industry or anything trading related where I can go and pay someone $50 to then get access to $5,000 worth of trading capital. It just does not happen. That is the one good piece to these prop firms, but you have to keep in mind and approach them with a grain of salt. If they switch you over to a book, honestly, yeah, basically only beneficial for the broker. I didn't even know till I looked. I looked it up online before making this webinar. I was taking some notes and stuff. I didn't even realize that you could see. But yeah, I was able to look it up on my Forex.com account, and honestly, I didn't even know. I didn't get, they didn't send me an email, they didn't message me, nothing. So, it obviously is only beneficial to them, so I'm sure they don't really care to notify the trader. But yeah, it's one of those things. Yeah, of course. I think it's important to understand, because I have been seeing people who are a little upset about their evaluations they're taking. For example, someone was saying they've taken a ton of break-evens lately because spread and slippage have just been ridiculous. And I don't want you guys to feel like that's how the normal market conditions are. I've never had an issue with slippage or spread since I started trading with Forex.com, but it is a regulated broker. These simulated prop firms where you're trading on essentially fake accounts, fake capital, but they're being paid out with real money. So they make their money from the evaluation capital. You go and pay $50 to get a 5K account. The majority of traders fail, so they obviously get a lot more money than they have to pay out. But the one difference here is now that it's a simulated 200K account that you might be trading on, they have to manually have a formula that represents things like slippage and spread and all of those factors that are within the typical live market they have to now simulate that. Commission is even included in that. So all of these formulas can be amplified at whatever value they essentially want, because there is no regulation in the prop firm industry yet for keeping that under control. So if I really wanted to, some of these new firms could sit there and go, okay, I want to amplify spread, slippage, etc. by 3x of what it might be in the live market. There's unfortunately nobody who stepped in yet to say they can't do this. In the US, obviously, we have had regulations hit down pretty hard with firms. So we are completely cut off from these simulated firms, which I think is personally better. But I do think using them for the leverage of capital is a great thing. You just need to understand that they are unregulated and they're essentially dangerous for new traders who put them on such a high pedestal, because they might say, okay, I really need to get this 200K account. Like, they set their life goal of being funded. And the issue with that is obviously you are now working against this prop firm in this company as a trader. And it's not really fair to you. But, I just think it's very, very important to understand what's going on behind the scenes there, because as a trader, if it psychologically affects you, you are going to be at much more of a deficit than you need to be when in the live market. And then I do want to go over, I might have just hit break even on GU. I did not check it yet, but I was risk free on GU. Pound Chef was another trade I took this week as well. One of the other things I was going to go over today was a little bit out of my document here, which is the What School Won't Teach You document. And I actually put this, which is pretty cool. I've never done this before. It's 53 pages. I submit it to ChatGPT here, and I told it, can you rewrite this, reorganize it, and make it more grammatically correct? Because obviously I just wrote this off the dome. It wasn't too well organized, I will admit. It's basically 50 pages of me just brain dumping a bunch of financial knowledge, which if you haven't checked it out, please do. It's in the server. It's in the investing section here. And if you scroll up a little bit, table of contents, please check this out, because personally, I think this is worth the value of the entire mentorship times 10. It's an entire book on personal finance, like everything ranging from net worth calculation. Oops, go back up here. But literally everything ranging from banking protection, credit card and understanding credit card debt, loans, student loans, career options, housing options, home ownership, stuff like how to get a mortgage, types of mortgages, house hacking, buying your home, negotiation, closing costs. It literally covers everything you can imagine. Personal investing, risk allocation, stocks, index, bonds, LLCs, business law, tax savings. I mean, I personally think that this one document is more than the value of the mentorship times 10. Obviously, maybe I'm biased here, but this was a lot of information. So I submitted to ChatGPT and asked it to kind of reorganize it, and I'm interested in seeing what it comes up with. It actually told me that it might take 2 to 3 hours, and it said to hang in there when I did it, which is kind of funny because I didn't know, ChatGPT could even do that. They switch you to a book. Okay, I want to make sure I didn't miss any questions here. But yeah, so I'm interested to see. I'll probably end up re-uploading it in a better formatting. If ChatGPT spits out something that I actually like, formatting and chapter-wise and stuff, because I told it to organize it better. But one of the main things I wanted to do here was go over, let's get rid of that. Just like the first chapter, I'm going to talk a little bit about base financials. And what I mean by that is calculating your net worth. And then I might dive a little bit into budgeting and expenses, just briefly, the app that I use, because I do really like it. I'm not sponsored by it or anything. And then maybe financial goals as well, as I think is a good one. But when it comes to base financials and calculating your net worth, very, very simply, your net worth is all of your assets combined, subtract all of your liabilities, and then, of course, total assets minus total liabilities equals your net worth. So what I mentioned here is that your goal is to assess your net worth on a yearly, quarterly, or even monthly basis. If you're brand new and starting out to wealth building, I recommend monthly. And the reason why is you want to get a good gauge and understanding of how you're growing month over month. This is if you're a small business owner, even if someone has a job and they're new to getting an income like that. How much are you saving? How much are you investing? It's very, very important to track it a little more often if you are new to your journey. Myself, I personally track it quarterly. Just kind of the preference I've found. I think yearly is a bit too long. You're not getting a good gauge of what's going on within that year, but you want to basically assess your growth or the lack thereof and gauge the speed at which it's occurring. If your net worth month over month is growing by $10, there is not an issue there, but you need to increase your income or you need to limit your liabilities. So some of the things that we're going to talk about here is if your assets are things like your bank money market accounts, CDs, cash that you have. It could even include something like your house, the land, or rental property if you have any. Even if you really want to get down to the nitty gritty of it, I don't personally do stuff like furnishings, jewelry, furs, things like that. But if you really, really wanted to, you could dive into some topics like this. And then you're subtracting that value or subtracting liabilities, which is your things like mortgages. A lot of you may have student loans. Credit card debt is a huge, huge one. Or anything like this, you're subtracting it from that initial asset. And then that is going to get you your net worth. So what I want to do here is I kind of just made a mock one. We'll go over a very quick example. Honestly, I might just do like Q1 2024, show some examples, and then we'll show the graph here and kind of how you can gauge your growth. Let me make sure, and then obviously I will go and share this document with you guys once I'm all set here. But let's just say, and keep in mind, I am from the US, so my standard of capital is a little bit different. I understand there's other countries out there who, don't necessarily have as much capital or the GDP is much lower, so your income is much lower. It's perfectly fine. Just gauge it based on, take it with a grain of salt, what I'm going to go over here. But if in your first checking account, let's say you have $1,000, second checking account, we'll say you have $2,500. In savings, typically my recommendation for savings or cash savings is a 3 to 6 month emergency deposit or emergency fund is what some people call it. And essentially you want to take your bills for the next 3 months and then multiply it by 3 to 6. And that should typically be where your cash sits around. In this example, let's call it 10,000. And then your investments, I would hope you can scale your investments with time. We'll do an example here of 25,000 invested, Roth IRA. Let's just go 0, no property. Your car, let's say it's worth 2,000. And then other, we're just going to go 0 here for example purposes. Now, I'm just punching in some random numbers here, so don't think too much about it. But I just kind of want to show you how the sheet works, how you should do it yourself. And if you really want to dive deeper into different topics, you can. But the main number to focus on here is total assets. That is about 40,500. Now, some people, they think that this is their net worth, when in reality, this is not how that works. So let's say credit card debt. You have around $2,000 in credit card debt. Student loans are another big one here. Let's say 24,000. Puts you at about 6,000 a year, which can be pretty standard here in the US, if not even more, definitely more. But a mortgage overall, let's call it, you have a $120,000 mortgage remaining on your house. And then your auto loan, let's just call it a $5,000 auto loan and no other expenses. So the reason, obviously this is skewed a bit. Some of you may not have a mortgage, so we can zero that out if you'd like. But the reason I punched this in is to really show you guys the stuff like student loans and a mortgage are detrimental to your net worth overall. It does not mean you are $40,000 in the green because you have $40,000 in your accounts. But overall, the goal here is once you get to Q4 of 2024, where we are now, you'd want to see some form of growth in the majority of these accounts here. Let's call it, you're still saving that emergency fund of 10 grand, which is fine, but you were able to put away a lot more in investments. We'll still zero out some of these columns. And then we'll say your car value has now depleted to 1,500 after the year, which is a bit extreme, but, and then in Q4 here, you were able to get rid of all your credit card debt. Your student loans are now 20,000. You paid some of it off, no mortgage. And then your auto loans, similar idea. You were able to pay some of it off. Now, graph looks extremely ugly. Oh, I see, because it's putting it back down to 0. But obviously, you guys can kind of see the jump that was made here. So your overall net worth was a massive increase despite these accounts not increasing terribly much, with the exception of this one. But the key here to really understand is it doesn't always have to be a growth in income and savings or investments, but it can also be paying down your loans at a significant rate here. There's a $4,000 discrepancy here. There's a $1,000 discrepancy here. So it can come from both ends of the equation. And obviously this is, very simple to some of you guys. Like, this is a no-brainer, I hope, for some of you. Assets minus liabilities, but I do kind of just want to show you guys how to use the sheet. And what I recommend is every quarter going through here and making going through here and kind of gauging your own, because this will not only keep you accountable, but give you an actual clear coat understanding of where you are. Because another issue I will say is some people on their wealth building journey, they want to feel like they're doing much better than they really are. It's unfortunate, but that's just how the brain works. So this will not only keep you accountable, but as the years go on, you do want to see your overall bottom line increasing, and you want to get a gauge at what rate it is increasing at. I think it's very important. So I am going to share this document with you guys. I might even put it into the investing section. Might even rename this to personal finance, for example. And I talk about opening your investing account here. I talk about obviously this 50-page document, and then another investing video. So maybe I will rename that section, but I do just want to briefly show you guys that. I know it sounds self-explanatory, but I think it's pretty important to track stuff like that and track different metrics to keep yourself accountable and on track. And I do have, about 20 minutes left here, so I do want to go over the charts a little bit. Cool document. I definitely think it's important because it keeps you on track. Writing everything down. I do know a lot of people who kind of just, they're like a paper bag in the wind. They just let it happen. Expenses come and go. The other one in the document that I did want to talk a little bit about was budgeting. So X amount of money in X time. This is just financial goals, talking about, a realistic expectation of how much capital or how much you want your net worth to be by certain ages. But budgeting and expenses is another very big one. I think keeping track of this is the minor scale, while the macro scale is something like your net worth every quarter. I think you should be tracking just about weekly, if not bi-weekly, if you get a paycheck every 2 weeks. How much of your paycheck is coming in and how much is going out is detrimental to your net worth and your growth, because truly building wealth does not come from how much you make. It's coming from how much you're keeping out of that that paycheck that you're making. If you make $700 a month, you can manage to keep 600 of that. Obviously a little bit unrealistic, I will say. There is bills and stuff that you inevitably have to pay. But if you're making 700 a month and you're able to keep a vast majority of that, you are going to be in a better place than the person who makes 10,000 a month, but all 10,000 goes out the door, and then they end up maxing out credit cards for the rest of their bills because they can't cover it. So keeping the expenses low is key. I actually use an app called like NerdWallet. Let me see if I can find it here. Not sponsored by it or anything, but I do kind of like it. Let's see. I think it's this one here. So I'm not going to sign in, obviously, but I like it because it's an app on my phone, and it kind of just shows me how much comes in each month into my main checking account. It doesn't include my investments and stuff. I think it can if you link it. And then I don't have my credit cards linked because I have the same amount of bills I put on the credit cards monthly, so it doesn't necessarily matter. But it shows how much comes in and how much goes out each month. Or you can do weekly, I believe, if you want. And it gives you a really good gauge on how much you are keeping, not only how much you are making, which is super important. But I just recommend it because it's a super simple app. Like, I just linked my bank account and it automatically filled in all of the details of what comes in and what goes out. And then obviously I do have a little bit more here. If you guys haven't read the document about compounding, the rule of 72, talking about, I guess I can go over the rule of 72 briefly. I have some time here. I do want to do a little bit of charting at the end of this if I do have time. But the rule of 72 essentially states that your capital every roughly 7.2 years will double if you are returning an average of about 10%. So a few simple ways to use it. Divide 72 by expected rate of return, and that'll give you the number of years using compound interest that you can expect your initial capital to double. So a few pieces that we have to understand first. The compound interest part here means that you need to keep that money in the investment account. If you go and sell it off and put back in and sell it off and put back in, you're losing the compounding and you're taking tax each time. So it needs to stay in the account. This is more likely for a retirement account. And then what we have here is an example of this where you're investing $5,000. Actually curious here because the math does not look correct. Okay, so I think you're investing an additional $5,000 a year here, which does make it a little bit different. But the general idea is that if you have, let's say, $100,000 in your brokerage account and you have it allocated towards decent stocks similar to the S&P 500 that deliver on average 8 to 12%, let's call it 10% on average, it does mean that in roughly 7.2 years or every 7.2 years, your capital will double. So if you are 20 years old, you have, let's say, 10,000 in your brokerage account in something like the S&P. By the time you are about 27 years old, it should be $20,000 and double. And then by the time you are 34 years old, it should be roughly 40,000. By the time you are 41, it should be 80,000 and so on. And obviously this doesn't account for you adding more capital in, which you really should be. Don't just set and forget your money. But this is an example of where if every year you took about $5,000, and which I think is very reasonable, that's, I can't tell you how much per month right now because my math, I don't want it to be too far off. But if you break it down monthly, it's not terribly bad. Putting away 5,000 per year, depending on your income, of course, make it proportional to your income. But overall, year one, you might have about 10,500. And this means that you started with 5,000 and then you put another 5,000 in and it gained $500 because of that 10% return. The next year, 16,550. So you're now gaining even more onto that capital. And then obviously, as it goes down in compounds, after 10 years, you're nearing $100,000 from about $50,000 being invested. So it almost doubled your entire capital in the 7.2 years, like we talked about here, using the rule of 72. So that's another thing I did want to talk about. Inflation. We can maybe dive into some of these at a later time because, like I said, I have this thing being redone right now by ChatGPT and reorganized. I'm curious how it organizes these topics because they are a little out of order. But when the average market returns is about 10%, if inflation is 4%, you have to understand that you are technically making 6% after inflation. That's just something very important to understand from an investor's perspective, because some people do negate that and don't think about it. But in times like now where inflation is 2%, it's somewhat negligible compared to last year or the year before where inflation was nearing 10%. All of your gains from the market were essentially getting eaten up by inflation. So keep that in mind, please. And then I do want to go through some of the charts here. I don't want to dive too deep into that document. I had a pound chef trade, which obviously you guys know I don't focus too much on higher time frame, but I really did like this range that we were working within here. We just had a break of structure, strong low, strong high, price retraced into it with very low and slow volume, which to me is fairly good because it shows me that we are making a slow retracement to then mitigate and very likely run target highs. And this trade for me just followed in line with that. It was very ugly when you look at these general ranges that are occurring here. But overall, I saw this low and then it swept liquidity here, broke structure. So I was willing to take this buy. I will say in most cases, I would avoid something like this due to the ugliness of the range here and how low and slow this pullback was. But I kind of did like the pairing here with this this larger range that we were working within, and it worked out pretty well in this scenario. And then I have pound USD. Many people had this trade. It's essentially just a sweep on liquidity, break a structure, fair value gap. One thing I did notice here is we just took a great pool of liquidity. So yes, it's very possible that price could go and run bullish now. But with that being said, do I let it affect my execution? No, I still execute the trade regardless of what I'm seeing to the left or what other factors may affect it. I think that's very important. Some people see this, they scare themselves out of the trade. That's kind of why I have the break even rule here. It helps me negate the, fear of going into this trade because we just took some liquidity pool. It still allows me to tap in, go risk free on the position, and then if price runs in that expected direction after grabbing liquidity, it's perfectly fine because I no longer have my risk of capital on the table. Other charts where I see trades, I don't see too much going on. I briefly browse through them, and I'm not a fan of price like this. And I do want to make another thing clear going into November. It is an election month. EuroCAD and AUD NZD. I'll go check those out after. Didn't get tapped in on GU, really? Oops. But one thing to keep in mind with this low volume I was just talking about here on USD JPY is we are going into an election month, which notoriously for the foreign exchange market can kill volume or make explosive volume. It can be very, very volatile during election times. So just keep that in mind. I typically don't pay it no mind. I just trade however. But it's one of those things where I'm interested in seeing how the markets react to it next month, but we will see. And it's typical in an election year as well. Let's see, you mentioned EuroCAD, which I do know what trade you're talking about here. Should be this high to this low. I didn't end up taking this just because the range is a little bit large for me, but I think it's still a great trade. I love the sweep on liquidity here. I love the consolidation. We talk about that all the time. Consolidation, impulsive sweep, and then a very aggressive break of structure the other way. So very, very good trade here. I think you mentioned you were risk-free already, and then obviously 3R target at the low here. And then I think AUD NZD was the other one you mentioned. Also one I did not see or have, but definitely a pretty solid trade as well. We have the low to the high here. We have the general sweep on liquidity. You can kind of consider it any of these intermediary lows here, but I like the fair value gap, the impulsiveness here, and then the break of structure. So you're working within this range low to this range high. Once again, already risk-free on it. I'm not sure if you didn't get tapped in on this initial area here, and maybe that's why you mentioned you were risk-free. Otherwise, it might be break-even if this tapped you in. If not, though, I can see you would be at 1R risk-free now, and price is still running, so that's a pretty solid trade, too. I'm going to mark these, or keep these both up here, just to kind of gauge how they play out. Is there any other setups that you guys see? I waited for NZD. Let's check that one out. Oh, I don't have NZD CAD, that's why. NZD CAD, Forex.com. Let's see. Waited for it, but it left. Are you referring to the buy position maybe here? I think, okay. So yeah, I do like that one as well. Break a structure to the upside, a sweep on liquidity, and then the fair value gap right around that entry level. But yeah, I can see that being a very close miss here. And there was another one that I saw people talking about this week that I did not see. Wonder if I can find it in the swing trades channel. This one here. Oh, it was NCD CAD, was it? It was. Okay, yeah, because I was going to say this is a nice setup, one that I didn't see, but I obviously don't trade NZD CAD, so that kind of explains that now. But yeah, I think that's overall another great one. Both good setups here too. Is there anything else that you guys see? Oh, what's up, Goggins? I didn't even realize you were in here. Is there anything else that you guys see for this upcoming week? Personally, don't see too much. I really, really prefer to avoid these types of areas here. If this were a stronger break below the low, I'd be willing to take that. We didn't get a candle close there. I really don't see too much else. I'm definitely avoiding a lot of this volume, which, like I said, could be due to election time. I did see a student send me this one, which the structure point wasn't the greatest here, but I do think overall they were using a bit of a higher time frame influence regarding this sweep of liquidity here, which is a great example of a sweep. I love the impulsiveness of it, the break of structure. So this wasn't one that I personally had, but definitely another good example of a trade as well. Why do my colors look darker? And then what else do we got here? I don't see too much else for the upcoming week. Hopefully we start seeing price get a little bit more volume. Most of it is because there isn't much volume going on in general. But yeah, any other questions before? I liked NZD Chef from the structure, but it was a bit too big of a range. NZD Chef. Too big of a range? I'm not quite sure if you're referring to this very, very large one here, or last week I was in a big loss, so I decided to take a break. What do you mean by a big loss? As in like one trade that lost a lot, or you lost, in a significant losing streak? I forward test in GC and it's a win. This to me is like the epitome of trading psychology here. If you don't mind me, yeah, because I will say last week being in a big losing streak, losing that confidence in your trading plan, so you say, okay, I need to take a break, but then the one trade that you forward test is a winner. This is why backtesting is so important, and this is why trading psychology is so important. Is this to me is like the poster child of why trading psychology affects your performance. It's one of those things. If you had the data to support a losing streak, let's say it was a 3 trade, 4 trade, even 5 trade losing streak, having the data to support that and say, okay, it's actually inevitable that I will take a 5 trade losing streak within a 50 trade period regarding your win rate, you would hop into GC no problem and end up taking that winner. The issue is the psychology side of it, where you're like, okay, I'm on a losing streak, I need to take a break, and then you go and miss out on the trade that should come and repair your data. Very, very important from a psychological standpoint to try and, trust the edge, trust your data and analysis. Yeah, that's another thing too. Taking a break. It's one thing though where if you take a break for a month due to, work reasons or whatever, I think it's perfectly fine. It's a kind of a different scenario. But obviously taking a break because of a losing streak, I think is a different case. But yeah, September was a really good month for me in my opinion as well. I had I think 4 winners and then 3 losers, maybe 2 losers. I kind of forget at the moment. But I had a good month in September. October has been pretty slow for me. Not too much going on. I did just get this pound chef winner, which is a really nice one. But yeah, not too much otherwise going on. But I did take the first week of October off to work on something else in another business. So I was not trading actively for too much time this month yet. I think these are great setups though too. I did not really catch. I saw the EuroCAD one, but it was a bit large of a range for my opinion, so I kind of wanted to sit out of that one. But I didn't even really catch this one, the AUD NZD one. Would a Euro AUD be too aggressive? Let's see what we got here. I can already answer before looking at it. It might be too aggressive for me if that's a question being asked. It's not too bad though. I see what you're saying here with the sell position, sweep on liquidity, like so, and then your break of structure. Oops. So if that's something that's typical in your backtesting, I think that's perfectly fine. I thought it was going to be a bit more aggressive of a range. I have people ask me that, and some of the ranges are very, very small and very aggressive, which is a little bit outside of my realm. I like to take these much kind of larger ranges or more clear and defined ranges. But no, I think that's a pretty solid setup, especially if it's something you've seen in testing and follows their rules. Is there any questions before I tend to wrap it up here? And then I'll be able to get this uploaded to Yassine, because I know you mentioned you couldn't hear me or my audio wasn't working well. Hopefully in the recording it sounds good, I hope. The winner on, yeah, so I was going over that a little earlier before you hopped in. I even admit the price was disgusting, but I actually did come out of a selling position and broke even on that. The prior week I was kind of just following these ranges here, and then I took the break even on this one. So I was shorting here, took the break even after price came back up, and then I kind of essentially was just focused on this larger range, and liking the idea of coming to run this target high. I don't typically use higher time frame bias, but if I can see it on my screen like this in the 4 hour, I'm willing to kind of go for it. But fair value gap was present. I like when there's these intermediary lows. And I talk a lot about significant liquidity sweeps being ones where this low breaks a high. I really like that because I feel like it strengthens that low as a liquidity point compared to, using something like this as a liquidity point, which I'll admit was not my cleanest one, because it didn't necessarily come and break a low or anything before. But yeah, I had this low, this high, saw the break of structure in the fair value gap, so I decided to go for it, and that one worked out pretty well. And then GU, I'm actually kind of in the opposing direction here, but same idea, sweep on liquidity, all this consolidation, very aggressive break of structure, huge fair value gap, so that's another one that I'm in at the moment, but it looks like I'm going to break even pretty soon. If not, I might have already. The voice is killing me. Still have the order. Yeah. I think that's fine. If you still have the order pending on GU because you didn't get initially tapped in, um, we could easily see it come up a little bit deeper in the price and then drop as well. And this can be a point on liquidity. So I think that's perfectly fine. But yeah, I managed to get tapped in here and then have my break even set. So we are probably coming close to it if we haven't tapped it already. Is boating season? Boating season? 34 degrees out today. Ridiculous. What is it 34? I think it was 30 this morning. 62. I think that's a lie. Yeah, it's definitely this morning was brutal. When I was heading to the gym, it was like 30 something and I could see my breath in my car. But that's actually crazy if it actually is 62 here. Warmed up pretty nice, but cold shower season, that's every season for me. I love cold showers. I don't take any hot showers anymore. I've been taking cold showers year round forever now. I actually bought that sheet that you showed me the other day in DMs. My showers in summer aren't cold enough. Yeah, I can get that. That sheet you sent me in DMs, I have it. It should actually come in today. I bought it off Amazon the day you showed me. But see how that goes. All right, that might call it for this webinar, guys. I'll wrap it up here. Obviously, if you have any questions that come up after, you can ask me. But and then this recording, as always, will be posted in live sessions pretty soon. So see you guys. Hope everybody has a good weekend, and talk to you guys in next week's webinar.